Have you ever felt like your investment strategy is basically just chasing hot tips you hear about online or from a friend? Well, if that sounds familiar, you are in exactly the right place. Today, we're going to build a blueprint, a real plan to move you from pure guesswork to a repeatable, reliable system. Okay, let's get right into it.
It's a totally fair question. For a lot of people, the stock market feels like one giant casino, right? Prices swing wildly on news, on hype, and success can feel like you just got lucky with a lottery ticket. We've all heard those stories. Someone hits it big on one stock, and suddenly they're a self-appointed stock picker in their own brain. But is that really a path to long-term success? Or is there a much smarter way to play this game?
And this quote right here, this gets to the absolute heart of the matter. The real line between a gambler and a successful investor isn't luck. It's having a system. It's all about swapping those gut feelings and that fear of missing out for a clear, repeatable process that's based on solid, measurable criteria.
This slide just lays it all out. The two completely different mindsets. I mean, look at the left side, the gut feeling approach. Does that look familiar? The market drops and you panic sell. A stock gets hyped up, you jump in because you're scared to miss out. It's totally reactive, emotional, and frankly, incredibly risky. But then look at the right. That's the goal, a system. It's proactive, it's methodical, it's based on a plan that you built. You're not just reacting to the chaos, you're executing your strategy. Our whole goal today is to give you the tools to build that system on the right.
So, here's our game plan for today. First, we are going to build a solid foundation with a really powerful framework called the 4 pillars. Then, we're going to layer on top of that the timeless wisdom of Warren Buffett. And finally, and this is the most important part, we're going to show you how to combine all these ideas to become the architect of your very own personal investment system.
All right, let's jump into our first big concept, the 4 pillars framework. I want you to think of this as the actual foundation, like the load-bearing walls of your investment house. It's the structure that's going to support every single decision you make from here on out.
And the framework is built on these 4 pillars. First up, fundamental analysis. That's all about digging into the actual health of a company. Second, you've got technical analysis, which is about understanding the behavior of the market itself. Third is cash flow, your ability to actually generate income from your investments. And finally, number 4, risk management, how you protect your hard-earned capital. If you can master these 4, you're not just hoping for the best anymore. You're building a fortress for your financial future.
So let's start with those first 2 pillars, because they help us answer the 2 most important questions every single investor has. What on earth should I buy, and when is the right time to actually buy it?
This slide breaks down the 2 jobs perfectly. Think of it like this. Fundamental analysis tells you what to buy. It's like you're a detective investigating a business. You're looking at its earnings, its debt, its growth potential, its management team. You're asking, is this a solid, healthy company? Technical analysis, on the other hand, tells you when to buy. It's the art of reading supply and demand in the market by looking at charts and price. Here's the thing, you could find the greatest company in the world, but if you buy it at the wrong time, it can still be a really poor investment. You need both.
So how do you actually apply this stuff? A fantastic way is what's called the top-down approach. You don't just start by randomly searching for one stock out of thousands. No, you start from the 30,000-foot view. First, you look at the broad markets, like the S&P 500. Is the overall market trending up? You know the saying, a rising tide lifts all boats. You want to swim with the current, not against it. Then, you drill down. Which sectors are strong right now? Is money flowing into tech, or healthcare, or energy? Within those strong sectors, you find the strongest industry groups. And only then, at the very end of this whole process, do you pick the individual stocks that are leading the pack. It's a logical filter that really stacks the odds in your favor.
And here's where you turn that approach into real action. Instead of getting lost in 14,000 different stocks, you build a filter. For your fundamental criteria, you might say, okay, show me only companies with a share price over $10 and a PEG ratio under 4. That PEG ratio, by the way, is a pretty cool tool. It compares a stock's PE ratio to its growth rate, helping you find companies that are growing fast but aren't crazy expensive. For your technicals, you could filter for, say, stocks trading above their 200-day moving average. That's just the average closing price over the last 200 trading days. If a stock is trading above that line, it's generally in a healthy uptrend. And just like that overwhelming universe of 14,000 stocks shrinks down to a focused, manageable watch list in just minutes. Okay, so you've figured out what to buy and when to buy it. Now we've got to talk about pillars 3 and 4, how to actually generate income, and, maybe most importantly, how to protect yourself when a trade inevitably goes against you.
The third pillar, cash flow, is all about strategic flexibility. So many people think the only way to make money is to buy a stock and just hope it goes up. But a sophisticated investor has a whole toolbox of strategies to generate income no matter what the market is doing. Whether the market is bullish, bearish, or just chopping around sideways, there are ways to create a consistent cash flow. It's really the difference between being a passive passenger, just along for the ride, and being an active pilot who's in control of the plane.
Now, this might just be the most important pillar of them all: risk management. It isn't about avoiding risk altogether, it's about managing it. It means you have a plan for every possible scenario before you ever get into a trade. You use tools like stop-loss orders, which are just automatic sell orders you set at a certain price, to get you out of a position before a small loss turns into a big, painful one. And that is the crucial point. Long-term success isn't about how big your winners are, it's about how small you keep your losers. If you can do that, the winners will take care of themselves.
This quote just says it all, doesn't it? Getting a huge win feels amazing, but it can be pure dumb luck. What really shows skill, what shows professionalism, is discipline on the downside. When an investment goes wrong, and trust me, some of them will, can you stick to your plan and take that small, manageable loss without letting your emotions cause it to spiral out of control? That right there is the hallmark of a true system-based investor.
All right, let's shift gears for a minute and look at a different but very complementary system from one of the greatest investors in history. This isn't just about picking stocks. This is about becoming an owner of wonderful businesses. Warren Buffett's whole philosophy is famously simple, and it boils down to these 4 essential rules. First, he looks for vigilant, trustworthy leaders. Second, the business itself has to have durable, long-term prospects. He's not chasing fads. Third, it has to be stable and, this is critical, it has to be understandable to him. He famously says he avoids things he doesn't get. And finally, after all of that, the stock has to be undervalued. He figures out what he believes the business is actually worth, its intrinsic value, and he will only buy it if the market is offering him a big discount to that price. And this, for me, is the real secret sauce of the Buffett philosophy. It's not a checklist where getting 3 out of 4 is good enough. Nope. He is unbelievably disciplined. If a company has great leaders, a great future, and it's undervalued, but he doesn't really understand the business model, he passes. All 4 rules must be met. Every single time. It's an absolute masterclass in patience.
So now we have the 4 pillars framework, which gives us a process, and we have the Buffett philosophy, which gives us a value-based mindset. So how do we put them together? Well, this is the fun part. This is where you become the architect of your own strategy.
This slide is just fantastic because it shows how these 2 systems can work together in perfect harmony. They aren't mutually exclusive at all, they're complementary. When you ask, how do I find good companies? You could use the 4 pillars fundamental scans to create a list of interesting candidates, and then apply Buffett's 4 rules to find the absolute cream of the crop. For when's the right time to buy? Buffett gives you your value benchmark. Then the 4 pillars technical analysis can help you pinpoint your entry within that value zone. You really can get the best of both worlds here.
And that really brings us to the ultimate goal of all of this. It's about making a fundamental shift in your entire mindset. It's about moving away from being a passive tip taker and moving toward being an active designer of your own strategy. It's about being able to say with confidence, I bought this stock because it met my specific criteria, it fits my goals, and I have a clear plan for when to get out. That is a position of incredible power and control.
So we'll end with this question for you. The frameworks we've talked about today are incredibly powerful building blocks, but they are not a one-size-fits-all prescription. The real work, and honestly the real reward, comes from taking these concepts, adapting them to your own personality, your own goals, and your own risk tolerance, and building a system that is uniquely yours. So what criteria will matter most to you? How will you define your rules? That is the journey from being just another market participant to becoming a true market strategist.